and welcome to VidSec here. Before we begin today's video, there's a couple of things I want to share with you. First is the VidSec membership program that I spoke about in my last video. I hope so far VidSec has been able to provide some value to you, and in order for us to grow, I would highly recommend and request you all to join the membership program. Now there are two levels to it, the bronze investor and the silver stakeholder. As a bronze investor, you get customized emojis and a shout out from me in the next upcoming videos. And all that you have to do is pay ₹89 per month. Now the silver stakeholder comes at a membership fee of ₹399 per month, and you get everything from the bronze package as well as early access to my videos and members only videos. So please do make sure you utilize this opportunity and become a VidSec member. Now the second thing I want to talk about was, my last few videos I recorded them outdoors, but currently I'm unable to do that because of the weather conditions here in Punjab. So I just want to know from you all, what would you prefer? Me recording in a studio or the animated videos? Which format do you prefer? Do let me know in the comments below and we'll take it forward from there. So thank you so much and enjoy the video.
Hello everyone, welcome back to VidSec here, where we break down complex financial concepts into simple everyday language. In today's video, we're diving into indexation, a term that might sound complicated, but plays a crucial role in managing your investments, especially when it comes to mutual funds, equity, and taxes. And don't worry, I'm going to explain it with real-life examples to make things super clear. So let's get started. To put it simply, indexation is a technique used to adjust the cost of an asset for inflation. It helps you reduce your tax burden by accounting for the inflationary effect on the value of your investments. This is particularly useful when you sell an asset like mutual funds or equities after holding them for a long period. Think of it like this. Imagine you bought a box of chocolates for ₹100 2 years ago. Today the price of the same box has gone up to ₹120 due to inflation. However, you don't really profit from this price increase. It's just the result of inflation. Now what if someone taxed you on ₹20 price increase? That wouldn't be fair, right? You haven't gained any real wealth. It's just inflation. This is where indexation comes into play. It helps adjust the cost of your chocolates for inflation so that you don't pay taxes on the increase caused by inflation alone. Let's dig a little deeper. When you buy an asset like a mutual fund or equity and sell it after a certain period, you may make a profit, also known as a capital gain. But due to inflation, some part of this gain might not be real. Indexation adjusts the purchase price of your investment to account for inflation, reducing your taxable capital gain. Here's an example of how it works. You invested ₹10,000 in mutual fund 5 years ago. You sell the investment today for ₹15,000. Without indexation, your taxable gain would be ₹5,000. But if inflation over those 5 years was 20%, indexation allows you to adjust your initial investment of ₹10,000 upward. Let's say after indexation, your adjusted cost becomes ₹12,000. Now your taxable gain will only be ₹3,000. That's 15,000 minus 12,000 instead of the ₹5,000. That's ₹2,000 of capital gains you don't have to pay taxes on. Indexation plays a significant role in mutual fund investments, especially in debt mutual funds. If you hold debt mutual funds for more than 3 years, you become eligible for long-term capital gains or LTCG, which are taxed at 20%. with the benefit of indexation. Imagine you're baking a cake and it takes 3 hours to rise. Similarly, mutual fund investments get more beneficial over time. If you hold a debt fund for more than 3 years, it's like letting your cake rise fully. Now you can apply indexation to the profits and reduce your tax burden. On the other hand, if you sell a debt mutual fund before 3 years, the gains are taxed as short-term capital gains and added to your total income, making it much less tax efficient. Now let's talk about equity investments. Here's the twist. Equity mutual funds or direct stock investments do not get the benefit of indexation. If you hold equity for more than a year, you qualify for long-term capital gains tax, which is currently 10% for gains exceeding a certain limit. For example, rupees 1 lakh in India. Although you don't get the benefit of indexation here, the tax rate is already lower compared to short-term gains, which are taxed at a higher rate. So even without indexation, equity investments can still be tax efficient if held for the long term. The important takeaway is that indexation helps mitigate the impact of inflation on your investments and reduces the amount of taxes you need to pay on capital gains, primarily for debt mutual funds and other eligible assets. It's a smart strategy to optimize your returns and reduce tax outflows. Here's my final piece of advice. Understanding the taxation rules and using indexation wisely can significantly improve your post-tax returns. Always aim for long-term investments when possible, especially in debt funds to benefit from indexation. As for equity, though indexation doesn't apply, the lower tax rate on long-term holdings can still work in your favor. Indexation adjusts your investment's cost for inflation, reducing taxable gains. It applies mainly to debt mutual funds and some other assets. Equity investments don't get indexation benefits but have lower long-term capital gains tax rates. The longer you hold your investment, the better the tax benefits. If you're unsure about how indexation applies to your portfolio, consult a financial advisor or tax expert to get personalized advice. That's all for today's video on indexation. I hope this gave you a clearer understanding of how indexation works and how it impacts your investments and taxes. If you found this helpful, give it a thumbs up and don't forget to subscribe for more financial tips and insights. See you in the next video. Till then, happy and safe investing.